BigBear.ai, trading under the ticker BBAI, is currently sitting at $3.45 per share as of the middle of this Wednesday, April 1, 2026 trading session. The stock is seeing some significant intraday heat, up roughly 12.2% from its daily low of $3.07, even after touching a session high of $3.56. While a double-digit jump might look like a simple relief rally to the casual observer, the reality under the hood suggests a much more complex tug-of-war between high-frequency traders and institutional players. We are seeing a massive spike in volume today, with over 34 million shares changing hands, which is already blowing past the typical daily activity. This kind of movement usually signals that the market is finally reacting to the aggressive balance sheet cleanup the company has been executing over the last few months. The common expectation among most retail investors using the Robinhood app or browsing popular investing sites is that BigBear.ai is just another speculative AI play that missed its window. People see the 50% drop over the last 6 months and assume the story is over. But here's the reality that challenges that narrative. While the stock price was sliding, the company was actually executing a total financial overhaul. They've managed to slash their debt by more than 90% and now sit on a cash pile of about $460 million. For a company with a market cap around $1.68 billion, having that much liquidity is a massive strategic pivot that the broader market hasn't fully priced in yet. When you look at BigBear.ai through the lens of individual brokerage accounts or a self-investing strategy, you have to look past the historical net losses and focus on the fact that they are now positioned to actually fund their own growth without constantly begging the capital markets for more cash. The volatility we are seeing today is a classic example of expectation versus reality. The expectation was that the fourth quarter revenue miss would lead to a slow death spiral. The reality, however, is that the company is trading dilution for a much cleaner capital structure. Yes, they used an at-the-market facility to raise funds, which naturally frustrates current shareholders, but that move gave them the fuel to acquire Ask Sage and CargoSeer. These aren't just vanity acquisitions, they're high-margin, recurring revenue businesses that move BigBear.ai away from being a lumpy contract-to-contract government consultant and closer to a scalable software firm. This transition is exactly what professional desks at Fidelity Wealth Management or firms using the Interactive Brokers platform look for when they start moving from a sell to a hold or buy rating. Institutional activity is starting to tell a different story than the retail panic we saw in late 2025. While only about 7.5% of the stock is held by big institutions currently, we're seeing firms like Geode Capital Management and even the Arizona State Retirement System incrementally increasing their stakes. When the smart money starts nibbling at these levels, it's usually because they see a floor forming. The stock has been hovering around this $3 to $3.50 range, and as long as it holds above that $3 psychological support, the technical setup for a short covering rally becomes much more likely. Short interest peaked at over 30% recently, and with the price moving up 12% in a single day, those short sellers are starting to feel the squeeze. If you're managing your own portfolio through the Fidelity mobile app or checking your positions on SoFi Invest, you've likely noticed that the AI sector is bifurcating. There are the giants like Nvidia stock, and then there are the specialized service providers like BigBear.ai. The tension here is that BigBear.ai is often compared to Palantir, but they operate on a much leaner scale. While Palantir dominates massive multi-year government contracts, BigBear.ai is carving out a niche in edge computing and predictive analytics for the Army and global supply chains. Their 2026 revenue guidance of $135 million to $165 million suggests about 17% growth. This is the reality that the market is currently digesting. It's not a 100% to-the-moon growth story, but it's a stable, improving business model that is finally moving toward profitability. Let's get a pulse on the sentiment here. Comment below how many shares of BBAI you currently hold, or if you are waiting for it to dip back toward $3 before entering. Do you think the current leadership can actually turn this into a profitable SaaS business by next year? Getting your take on the actual ground floor sentiment is huge for understanding where this stock goes next. Looking at the broader context of online investing today, companies like BigBear.ai represent a specific kind of risk-reward profile. If you're using a SoFi robo-advisor or Schwab Intelligent Portfolios, you probably won't find a high concentration of BBAI because of its historical volatility and high beta of 3.49. This is a stock for active investing, the kind where you're digging into SEC filings on the Interactive Brokers trading platform rather than setting and forgetting. The company's recent earnings report showed a net loss of $5.8 million, which sounds bad until you realize it was a massive improvement over the $138 million loss they posted in the same quarter the previous year. That is a staggering reduction in the burn rate, driven largely by non-cash gains and debt restructuring. What exactly does BigBear.ai do to justify this $1.6 billion valuation? They focus on what they call mission-ready AI. Essentially, they take massive, messy data sets from government agencies or shipping companies and use computer vision and predictive analytics to help them make decisions in real time. Think of it as a specialized layer of intelligence that sits on top of existing hardware. Their acquisition of Ask Sage is particularly interesting because it gives them a FedRAMP-certified generative AI tool. In the world of government contracting, having those certifications is a massive moat. It's not something a new startup can just replicate overnight. This is why investors looking for investment help are often pointed towards the defense tech sector. The barrier to entry is just so high. The macroeconomic pressure shouldn't be ignored either. With the current focus on technology-led solutions in the federal budget, companies that can prove they save the government, there's that word again, or at least make them more efficient are going to be first in line for funding. BigBear.ai is positioning itself as that efficiency partner. However, the risk remains that their revenue is heavily concentrated. If one or two major Army programs get delayed or canceled, the stock takes a hit. We saw that in the fourth quarter when revenue dropped 38%, primarily due to lower volume on certain programs. That is the reality that keeps the stock from trading at a higher multiple. For those of you who prefer self-investing and use platforms like the Robinhood trading app or Fidelity trading platform, the strategy with a stock like this usually involves watching the moving averages. Currently, the 50-day moving average is around $4.33, and we are trading well below that. This means the stock is technically in a downtrend, but today's 12% bounce is a sign that the oversold signal on the RSI is finally being acted upon. If the stock can break back above $4 and stay there, the narrative shifts from struggling small cap to turnaround story. In the final outlook for 2026, the catalysts to watch are the integration of CargoSeer and the potential for a surprise move toward positive EBITDA. Management has hinted that they are in the strongest financial position in the company's history, which is a bold claim for a stock that was recently near its 52-week low. The expectation is that they will continue to bleed cash, but the reality might be that their new acquisitions start contributing to the bottom line faster than analysts expect. This gap is where the opportunity lies for those who are willing to do the deep dive on the Interactive Brokers fees and account structures to find the best way to play this volatility. To summarize the situation, BigBear.ai is a company that has successfully moved through its most dangerous phase, the threat of insolvency. By aggressively raising capital and clearing the debt, they've bought themselves the time needed to prove their business model works. The market is currently skeptical, which is reflected in the discounted price-to-sales ratio compared to its peers. However, the intraday movement today suggests that the narrative is shifting. The tension between the expectation of failure and the reality of a fortified balance sheet is creating a friction point that could lead to significant price action in the coming months. Whether you are using the Robinhood app for fractional shares or managing a more complex strategy through Fidelity Investments, the key is to stay grounded in the data. The hype has faded, and now we are left with the actual business, and the business is looking healthier than it has in years. We'll keep a close eye on the volume and institutional filings to see if this April 1st rally has real legs or if it's just a temporary breather in a longer consolidation phase. The reality is that BigBear.ai is no longer just a meme-adjacent ticker. It's a restructured tech firm with a $500 million war chest and a lot to prove. Stay focused on the support levels and the upcoming revenue targets, as those will be the ultimate arbiters of where this stock ends up by the end of the year.